there's no way anybody can predict, the number right now is 20%, I think. We wrote 50 offers last year. We underwrote hundreds of deals. And the pricing is definitely 10 to 20% off just in the multifamily space. We're seeing it in office. We're seeing it in retail. Not as much in warehouse. Warehouse is pretty hot still. I think you got to be careful too, because if you look at Cleveland, it's going to be different than Miami. And Miami's going to be different than Raleigh, and Raleigh's going to be different than Phoenix, and Phoenix is going to be different than San Francisco. So you got to be careful by, when you throw this blanket 20% over the whole market.
In this highlight, Ken McElroy breaks down exactly what to expect in the real estate market in 2023. While some markets are performing well, McElroy believes that you should be ready to anticipate further declines in the markets that are already collapsing. This is due to fascinating data McElroy cites from personal savings rates, Airbnbs, and credit card debt, as well as the steady rising interest rates that all suggest we are headed towards a deeper recession. Make sure you stay until the end, because McElroy reveals a strange recession indicator that'll surprise you because of how truly brilliant and accurate it is. Now let's hear what Ken McElroy has to say.
And look at the individual market, because Seattle, Portland, and San Francisco are getting clobbered.
Yeah. I was also reading Seattle is basically, they were saying it's on a buying freeze. So
it should be. You can't defund, and then people are moving. So you have people moving out. Then the interest rates went up. You just take a look at the net migration and where they're going. I believe that you're going to see, half a point to quarter point increases, through probably early summer. Everyone I've talked to kind of believes the same thing. When you take a look at inflation, it's got a ways to go. In March, I think we were at 9.1%. So 9.1% inflation. I think the last one we saw was 7.1. So it's only down 2% after 7 rate increases. One of the asset bubbles was real estate. The low rates created the bubble. All that's happening is that there's a hole in the bubble, right? So it's shrinking. Home prices are going down. What you're going to find is people are going to say, but we're still undersupplied, and we're still this, and we're still that. That's all true. But what's happened is that you can't double the rate and expect people to be buying at the same frenzy. It's happening in multifamily. Something that was priced aggressively October or August of last year wasn't getting offers because the cost of mortgage payment was so much higher and cash flow was less. What people need to pay attention to are, the ripple effects or the processional effects of what happens when there's no sales. We all know that there was very little sales compared to, the 6 months prior. So let's just say first 6 months of 2022, last 6 months of 2022 are very different. The real estate commissions are down, the title company fees are down, the insurance, everything, the contractors, the flippers, the hard money, everything that goes into that transaction slowed down. So those are all going to start to show up, in my opinion, next, in this first quarter and through this next 6 months. So in my opinion, as unemployment starts to creep up as a result of not just real estate. We're seeing it in tech too. Amazon, Zillow, Realtor.com. I think that's when you're going to start the Fed's going to have to declare a recession. I think we're going to start to see these Airbnbs, hit the market here in the next, few months. The people that bought a high-end or really nice properties and furnished them, and they're having a tough time getting the Airbnb rent. There's a little bit of disruption there, and I think that a lot of times they don't make sense as a regular rental. So I think that's something probably to watch. Not necessarily just in the high-end market. The other thing was interesting. Hopefully you guys know this. If you take a look at personal savings rates, just Google it. You'll see that people's savings rates are way, way down. On the same site, you'll see that people's credit card debt is way, way up. So basically what that means is that a lot of people have run through their savings and they're starting to use debt to maintain their lifestyle. So you have that also entering into this first quarter. That's going to affect if you're a home owner or a renter, whatever it might be. I think that's probably the next thing. I was talking to somebody yesterday about car repos are way up. I didn't even think about this one, but a friend of mine, Eric, said one of the things that he watches are pawn shops. Oh, that makes a lot of sense. When people start to get tight, the pawn shops do really, 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 really well, right? And when things are good, then their inventory is scarce. So there's all these things happening, and I believe, but that you guys can go online and look, and you'll see. There was an article today that you sent me on layoffs in the Wall Street Journal. A lot of it's going to depend on how long the people have had the home and how much equity they have in the home, and whether or not they need to move or not. So if you have a 2 or 3% or even a 4% rate on that home fixed, that's gold. You have to really stretch in order to get that same home. You actually, if you, in other words, if you're at 4 and the market's at 6 on the interest rate, if you move laterally, your payment's gone way up. So you can't move laterally. So you have to move up. So, to get the same quality of home. So a lot of people aren't going to do that. So it's going to keep a lot of people, going to keep them in their home. Yeah, and I think a lot of people are just freaking out about their loss.
Yeah.
Right? They look at that like a stock, It's not liquid. It's but as the home prices go down in an area and you start to see more inventory, and the potential of rates going up, I think it's going to get a little more dicey. The other thing that I'm seeing, in fact, there's a bunch of firms that go out and track rent growth or just rent, like month over month. They're projecting next year, in some cases, negative rent growth. What that means is that in some markets, we're going to see rents actually go negative. But I think it's interesting to note that we're bumping up against some affordability issues. And, so we're seeing it on the rent side. So you can imagine what's happening on the mortgage side, right? So you can't have 6% rates, let's say, with these higher numbers, even though they're coming down. People can't afford the monthly mortgage. And, so I don't see that changing as the Fed start to address inflation again for the next 4 or 5 months. This is a year, in my opinion, that you want to not try to push rent. This is a year that you want to maintain it. Cash flow. You want high occupancy, high cash flow. This is not a year to mess around, in my opinion. You don't want to try to get that extra $50 or $100. And, it's a win-win. The renter will be happy and you will be happy because you don't have to turn the unit. You don't have to market the unit. You don't have to clean the unit. You don't have to do any maintenance. You have to change out appliances or flooring or anything like that. What we were talking about before about recession-proof businesses. So if your tenants are working in businesses that are struggling from the recession and their income is also maybe tied to that in some way, then they're going to have problems paying the rent.
Click here to watch how real estate analyst Amy Dixon exposed how an Airbnb scam could burst the real estate bubble.